ready to rock and roll. Who? We're okay. You okay? You ready over there? All right, we'll go ahead and come back to order. The vice chair is got in a discussion with somebody, so we're going to go ahead and start. So we're on to performance update. So, Mr. Treasurer, who's gonna? Patrick. All right, fair enough. Mr. Fleming. Are we pulling in Josh too? Are we pulling in Josh remotely?
Here, Mr. Chairman.
Hello, Josh. How are you today?
I'm good, thank you. How are you?
Fine. Thanks for coming in. So we're going ahead and so Mr. Fleming, Mr. Kevin, there we go. We'll turn it over to you guys. So go ahead.
Thank you, Mr. Chairman. The performance of the Treasurer's Fund as of June 30. Josh is going to start off and go through the performance, and then I'll finish off going through the alpha attribution that we have always done for this committee after the June 30 numbers.
Go ahead, Josh.
Thank you, Mr. Chairman. Josh Keevan with RVK. Pleasure to see you again. I'm going to start on page 3 of our report, which I believe you should have in front of you. And this is just a quick update on the market value of the assets as of June 30, 2021. And total assets, you can see, are almost at 25 billion. And as you walk around the pie chart, just to orient you with the color coding that we use through much of the report, the green shaded funds on this pie chart represent the grouping of permanent funds that within the state's investment policy are referred to as the long-term total return focused funds, the largest of which is the Permanent Mineral Trust Fund. The blue shaded funds are the grouping of permanent funds that are referred to in policy as the income focused permanent funds, the largest of which is the Common School Fund. Yellow is the Workers' Compensation Fund. Red is Pool A, relatively small and hard to see on this pie chart, but right at 265 million. LISRA is pink, and orange for the state agency pool at roughly 5.4 billion. Now on the next page, as we look at the total fund performance, keep in mind that this total fund is a roll-up of all of those funds I just walked through. And those funds are very, very different from each other in terms of their purpose, their asset allocation, their risk levels. So I would suggest that the total fund in and of itself doesn't represent anything that's all that meaningful because of the very different nature of the underlying funds. But what is helpful to look at here is the difference line. And that simply represents across all of those funds, all of the strategies, all of the managers that are in place, after fees, did you outperform or did you underperform the benchmarks that are in policy? And for the most recent quarter, you can see it was roughly flat with that benchmark. And for the most recent fiscal year, which is the same as the 1 year at this point, it was positive, and it was positive to the tune of about 20 basis points. The bottom half of this page gives you the detail on the asset class level performance versus the primary benchmark for each asset class and policy. And as you just look maybe first at the absolute level of performance, you see that there were some asset classes that offered tremendous upside return last year. The best performers last year, and keep in mind the time period that we're looking at is June 30, 2020 to June 30, 2021. And so the recovery in markets had started by that point, and the recovery in the economy started last fall, and the markets accelerated off of that. And so the assets that have the best performance over this time period are generally those that benefited the most from improved sentiment around the economy, around reopenings, around positive vaccine developments. So, and generally were the things that had been hurt the most in the drawdown period from the first quarter of 2020 calendar year. So smaller companies offered some of the best returns. The index was up 62%. MLPs, which represent midstream energy assets, which had sold off tremendously in the first quarter of 2020, were up almost 60%. So from an absolute,
Josh,
yes, sir.
I got a quick question. Make sure I'm looking at this. I'm looking at, I think we're looking at the total fund performance, comparative performance. This is page 4, right?
That's correct, Mr. Chairman.
And so that's what you're referring to. And so as I look at this, so if you take the first one on that page, we've got at the very top line is total funds. This is across all funds. And then you've got on the right, in the left-hand column, as I understand it, you've got the asset classes. And so we're just looking at asset class by asset class of the total funds. And the top one is the benchmark, and the bottom, the lighter green line is the total fund performance of all across all funds. Is that how, am I reading that correctly?
Mr. Chairman, I would flip those. So take below the total fund. So looking at where it says where it says fiscal year to date or FYTD asset class returns.
Yeah.
The first one is US all cap equity.
Correct.
That first line where it says US all cap equity, that is the performance of your US cap equities.
So that's the benchmark. And then the one below, which
Nope.
is the same color as fund, is the total fund return in that class asset. Is that right?
Mr. Chairman, flip those two. So the first one is your performance. The one right under it is the benchmark.
So the US all cap equity, the 40.68%, that's versus the 40.79%. Which one is the performance and which one's the benchmark or the measure?
40.68% is your net of fees performance in that asset class.
Okay.
40.79 is the policy benchmark for that asset class.
All right. Thank you.
And that is not, Mr. Chairman, that is not specific to any fund. That is
Right.
across all of the
All
funds.
Okay. Thank you.
So in my initial comments are more on sort of where you got the best returns last year, as well as where you got the weakest returns from an absolute perspective. And as you can see, the weakest returns over this period came from fixed income. Over this period, you had rising interest rates. And so you can see core fixed income, you had basically a 0% return. Longer duration bonds, which you only have in workers' comp, where we're trying to hedge out some of the liability risk, you actually had losses on longer duration fixed income. Now, focusing in on the performance versus benchmarks. When you add that all up, you get that total fund positive 20 basis points. But you had asset classes where you outperformed and you had asset classes where you underperformed. Just to highlight a couple of the key drivers of that last year, the number one contributor to that positive alpha was international equities. And it's not to say that international equities is where you outperform the benchmark by the most, but when you weight it by the dollars invested, multiplied by the degree of outperformance, that's where the most dollars of outperformance came from last year. And I know Mr. Fleming will get into that in his report. One of your managers in particular, Arrow Street, did a phenomenal job last year against their benchmark. A few other areas where the portfolio is strong relative to benchmarks.
Mr.
Yes.
Chairman.
You have hang on, we got a question from Senator Kinski, Mr. Josh.
So Josh, I'm comparing page 2 and page 4, international equity. Page 2 is calendar year to date, and that shows international equity 9.16, the return. Whereas you flip to page 4, international equity is at a 39%. Is that just the difference between a calendar year and a fiscal year makes that much difference? Am I reading those right?
Mr. Chairman, Senator Kinsky, that's exactly right. The calendar year is only 6 months, or 6 months of 2021 calendar year. The fiscal year is the 12 months ended 6/30/21.
Okay, thank you.
So,
Go ahead, Josh.
another area where you, Mr. Chairman? Okay.
Go ahead, Josh.
Another area
Continue.
where we had some strength last year was in real estate, both in your core real estate portfolio. And you don't see it here because it's in the alternatives report, but also in your non-core real estate. So a little bit higher risk real estate strategies. And in both areas, though, your overweights to industrial properties. And if you think about what's going on in industrial real estate versus other types of real estate, that was a source of strength for your portfolio last year. The last one I would point out is on the opportunistic investments. Those last year were your highest performer and also the highest relative performer against the benchmark. So to the degree that the investment team has had that flexibility to take advantage of opportunities that come up that often require some pretty quick decision making, you can see that that has been very, very accretive to the performance of the funds. Okay. Before I leave this page, I'll just pause quickly, Mr. Chairman, to see if there's any other questions.
Go ahead, Representative Schwartz.
Thank you, Mr. Chairman. Josh, could you give me a little definition of opportunistic investment? I know what the concept is, but I'm not sure when you have a benchmark how they're defining it.
Thank you, Mr. Chairman. Representative, the benchmark for opportunistic is actually the total fund benchmark for the funds that are able to participate in opportunistic. And so think about for permanent mineral trust fund, any investment that's made in the opportunistic space has to be the benchmark of the total of the permanent mineral trust fund as a whole. And the thought there is it's really not worth doing if it doesn't exceed the benchmark of the whole fund. And opportunistic investments are intentionally not defined very granularly. But some characteristics that opportunistics tend to have in common would be oftentimes they are opportunities that present themselves either because of market stress, security prices get dislocated, or just by virtue of being in the information flow to be able to participate in an opportunity that one of your managers might present to the investment team. And that investment requires a fairly tight turnaround on decision making and wouldn't fit very well into this typical process that we go through to hire managers, where you've got the search, the IFC review, the slip review and approval. So it's usually in one of those two categories, either something that's just really dislocated and there's an opportunity because of market stress, or some opportunity that presents itself just by being in the right information flow.
Great, thank you very much.
Thank you. Other questions for Josh at this point? All right, continue on, Josh.
Okay, thank you, Mr. Chairman. Let's go to page 5. So I'm going to focus on the fiscal year-to-date column. That's the fiscal 1 year ended June 30. And very, very strong returns for the funds here. I'll start up at the top, Permanent Mineral Trust Fund. These numbers are all net of all investment management fees and costs. And so net of fees returned last year of 21.6% for PMTF. You can see that exceeded its total fund benchmark by about 0.5%. And there's a benchmark below that that we also show here, really more as a reference point. That it's not a policy benchmark for PMTF, but it's the 70-30. It's a benchmark, 70% global stocks, 30% US bonds. And we show this here because you approved, there was in statute, a change to reference this idea of a 70-30 stock and bond benchmark really as sort of a maximum risk level for the permanent funds. And so the maximum risk level, sort of very simple expression of that, 70% stocks, 30% bonds last year returned 26.3%. And the PMTF is not at 70% equities, so it's below that. But I think it is worth noting a couple of things here. One is the last couple of years, there has been some pretty significant progress made to improve the asset allocation of the funds, and in particular, the longer term total return focused funds. And more money has gone into equities, more money has gone out of bonds and into other diversifying asset classes. And last year, in a year where basically the more risk you took, the better you did, the Permanent Mineral Trust Fund was able to capture 82% of what that very simple 70-30 stock and bond portfolio captured. If you had the asset allocation structure from 4 or 5 years ago, or back when the limit was 55% in equities, you wouldn't have been anywhere close to 82% of that return. So I think it is worth noting that the changes that have been made over the past several years, I believe, have added significantly to the returns here. Now, the Common School Fund, go down to the income focused funds. Those funds have higher income requirements, and they're invested to meet those, to do a better job of meeting the distribution policies of those funds. And as such, they have less in growth assets. And you can see what the delta was last year between the two types of funds. Common School only captured 61% of 70-30. And as you look at the past 5 years, you've now got an annualized return gap between those two of about 1% per year. And so I think this is just worth noting in the context of the discussion you were having around the accounting treatment of, or the accounting focused nature of the way your constitution and active admission is currently pointing towards income. It does influence investment decision making, and that does have consequences. Just to round out the funds here, workers' compensation did quite well in spite of the fact that it's got roughly 60% of its assets in liability hedging fixed income with longer duration, which I showed you did very poorly last year. It does have some balance and some risk assets and was able to still perform quite well last year. Page 6 is the LISRA data at the top. And just to explain what you're looking at here at the top, there's LISRA total fund, and that is made up of the 3 lines below it. LISRA is roughly a third in each of the categories: short-term reserve, intermediate term reserve. Those two are both 100% fixed income. The long-term reserve is in longer term, higher risk, growth-seeking assets. And that portion of it returned 34% last year. In total, the combination of those 3 underlying pools, you had about 10.7% net in LISRA last year. Pool A at 12.3, also well ahead of its benchmark. And the state agency pool is the most conservative of all of these funds, 100% short-term, high-quality fixed income, and that just doesn't pay very much these days. Just a few final comments here on the next couple of pages. On page 7, this page is showing you standard deviation, and it's showing you how standard deviation has changed over time. It reads left to right, and standard deviation, by the way, just as a quick refresher, is the measure of volatility in the returns. It's a measure of risk. It's not a comprehensive measure of risk, but it does give you a sense of risk, at least from the standpoint of how much can the price change, or how much is the price potentially going to change of our investment portfolio. And the purple line is the 70-30 portfolio. So the one thing that may be useful looking at this page is It's actually a backwards looking test of whether or not the portfolio has stayed within the statutory limits of not to exceed the risk of 70-30. And you can see that going back over time, these portfolios have not been run anywhere near 70-30. In fact, they couldn't legally invest anywhere near 70-30. There has been progress, though, as I noted, that risk has come up over the past several years, and it's come up even more for the green shaded funds than the blue shaded funds.
Hey, Josh.
Yes, sir, Mr. Chairman.
So going back to looking at that chart on page 7, the really bold purple line, that has to do with what we, it was the last year or the year before we put in statute where we said that when we changed the directive so that we go for the highest risk rate of return, but in no event, basically that was the upper limit. That was the most risk that we said that the treasurer's office could absorb in the context of seeking the highest risk rated return. Is that correct?
Mr. Chairman, that's exactly right.
And so, and then as to interpret this chart, then it just shows what the risk measurement was for the various, and the color codes mark back to the color codes that we just saw on pages 6 and 7 among the various funds. Is that right?
Mr. Chairman, that's correct.
Okay, thank you. Appreciate that. Other questions? Thank you, Josh. Continue.
And the last page I'm going to ask you to look at is page 9, Mr. Chairman. This is the same data, but this is looking at, instead of just risk, this is looking at the Sharpe ratio, which in its simplest form you can think of as returns divided by risk. Technically, it's actually returns above cash divided by risk, but you can think of it as a measure of how efficient has the portfolio been in terms of generating return for the degree of risk that was taken. And it's an important objective that's very clearly stated out in the investment policy. And as you look back over time, these portfolios, and this is just focused on the green and the blue line. So this is just PMTF and Common School. If we added all the other lines, this would be too hard to look at. And those are really the only funds where this 70-30 comparison is really applicable anyways. Over most time periods, and these are rolling 3-year time periods, so it reads from left to right, and every point on that line is that measurement for 3 years trailing at that point in time. Not 100% of the time, but probably 85+% of the time. Looking at past 3-year periods, your Sharpe ratios have actually been better than simple 70-30. But the returns have been lower because of the risk level that I showed you on the prior page.
So Josh, quick question on interpreting this one. So let's go and is the axis, the y-axis, the axis on the left that goes from 3 to -2, top to bottom, is that a percentage in help us understand that? I mean, so what I'm trying to get at is when we see, so if you look at the difference between the bold line and then basically the permanent trust and Common School Permanent Land Fund, those lines are right together. If you go to that first one where they jump above, which was in 4 of 2007, difference between those two, what does that tell us when we see the lines above the 70-30% index Sharpe ratio?
Mr. Chairman, excellent question. It's not a percentage, it's a ratio. So it's a ratio of return per unit of risk. And when you want to see the lines for your portfolios above 70-30, and when it's above 70-30, that means that your portfolio has generated more return per unit of risk taken.
So it's a good thing when it's above the line in this one. And it's a bad thing when it's above the line on the other one.
Mr. Chairman, that's exactly correct.
All right, thank you.
Mr. Chairman.
Go ahead, Senator Kinski.
So Josh, this line ranges from 2 to -1. Does that just reflect the changes in the rate of return on your risk-free asset you're using in the calculation of the Sharpe ratio?
Mr. Chairman, Senator Kinski, this actually it raises a really good point in that these measurements aren't static. And keep in mind, it's a ratio where both the numerator and the denominator are changing. And I showed you on if you go back to page 7, that's the denominator. Standard deviation risk is the number on the bottom of this ratio, and it changes. We go through periods of time where it's low, and we go through periods of time where it spikes. The big spike was the financial crisis. You can see that as soon as we get into like that fall of 08, that's when that risk number is shooting up. So volatility is not static, it changes. And we know that returns aren't static either, they change. And when the Sharpe ratio goes below 0, that basically tells you that that's when returns are negative, right? Because the numerator on top is negative. Volatility won't be negative. It'll always be some number above 0. But when the line goes below 0, that means the returns were negative. A lot of people, would tell you that if you can get a Sharpe ratio of 1, that's fantastic. Like if you can get an equal amount of return for the risk taken, that's really fantastic. It's not always possible because markets don't always allow that. But above 1 is unusually good. I think most of the time you should expect to see this number somewhere between 0 to 1. Does that help answer the question?
Yeah, no, that helps. Thank you.
Thank you, Josh. Other questions? Go ahead, continue, Josh.
Mr. Chairman, that actually concludes my prepared comments. I'd be happy to answer any additional questions.
Thank you, Mr. Chairman. A couple points that I just want to raise that Josh mentioned. If you could turn to page 2, when we were looking at the quilt chart that Senator Kinski addressed before. If you see on the far right column, the Sharpe ratios, that's the historical Sharpes of what we're looking at. And as you know, our number one mandate per the IPS is the highest risk-adjusted return. So that other chart that he showed on the Sharpe ratio, that's what we are currently trying to achieve. And so when we look at, comparable, returns from what we're doing versus other funds, that's, one of the mandates. So if you wanted to get a higher return, obviously you get, you take more equity, just like the LISRA. The LISRA return was a 34.4% return. That was because it only had 12.5% fixed income. And so all of this is asset allocation when you're looking at total return. And as you know, the SLIB board controls the asset allocation and we control the alpha production. So that is, we're mandated, here is your benchmarks, and that's what we try to do is beat it. But the other thing that I want to mention is if you take RBK's projection of the returns and the volatility of all of these funds over the next 7 to 10 years, these Sharpe ratios drop considerably. Like the private equity has a 109 Sharpe. It is about, I think, 0.45 or something on a forward looking. So what I'm saying is that because assets are so expensive right now, the Sharpe ratio or the risk adjusted return is much lower. For instance,
I hear this all the time on TV. It just says past performance is no guarantee of future performance. I think that's what you just said.
Well, absolutely. And our job is to look at the 10, we're looking at a long-term return for these permanent funds. We're not looking at the 1-year returns. But, Matt and I were just talking this morning, they showed us a stat with the current PE of the stock market now, and any time at this price or above, the next 5 years has been a negative return for the last 150 years. So again, all of these things that we're doing, to try and do anything at the margin with this very difficult investment is extremely important. The other comment that Josh made that I just want to highlight how important this is, and getting back to 121, I apologize if I'm getting back onto this, but the difference between the PMTF and common school, that 1%. So that equates to $46 million a year, or over 5 years, $230 million. That's the difference. Because common school has a 5% spend, you have to have the income to produce that. That is the asset allocation that we have because of that. So, if you want to quantify the cost for doing this, and then you could extrapolate that out and saying, okay, when you compare, and Paulie's going to show you endowments and foundations and what their returns were. Their funds are not inviolate. So it doesn't matter. They can spend, they can have much more risk. And if you have down years, so what? So we can quantify, and Paulie's going to show it out, of how much this costs us by doing it. Last but not least, just highlight, it's wonderful on the way up, but it's painful on the way down. You take more risk and you're going to lose more on the way down. So everyone talks about the upside that we're losing out on, but just to highlight, there's downside deviation as well. So the last part of it that I've always presented is the alpha part that we try to achieve every year. And this is 90% of what our office focuses on, is trying to achieve the alpha. So that's the chart that shows each one of the funds. So what this means is that if in fact that would be page 1, it is in your presentation.
Mr. Chairman, it's its own document after the 2 presentations, or the 2 stapled packets. Mr. Chairman, would you like me to put it up on the screen?
Sure. So this is every year. We show this to IFC and to the SLIB board, and obviously to yourself, to show what is the performance throughout the year. One thing that I want to note on, and just for reference, last year was approximately 80 million as well. So what that means is that if we invested these funds, if you can invest in all of these funds in an index fund, minus the cost and the fees of the index. This is the 80 million that we were able to achieve above and beyond what the index was.
You just said it, but I just want to emphasize that this is net of all fees.
That is correct, Mr. Chairman. So as I alluded to, we feel that the markets are very expensive, and I can show you all kinds of data. I don't want to bore you with that, but whether it's a bond or an equity, we're in the 90th to 100th percentile of richness over the last umpteen years, depending on how far you want to go back. And typically, valuation is a precursor for returns. And so there's all kinds of studies that you can go back when we're at this valuations. Real return on a 60-40 portfolio is less than 2.5% or less. The average real return on a portfolio over the last 50 years, when you look at these 60-40 performances, were approximately 5% real, not including inflation. So we're less than the 50% less. And if you take RBK's assumption, we're slightly above 2%. So those are the returns that the market is telling you when you are investing in these type of returns. This is what the forward numbers are looking at. Getting back to the alpha numbers. So what we've been doing is, you don't fight the Fed, right? The equity markets continue to run up, and they have been buying $120 billion of securities every month. There's so much liquidity in the system. It's the largest, the balance sheet of the Fed, they have over $9 trillion in security. Now the world is awash in liquidity and causing valuations to go up. So our concern is that we all know that the Fed has said they're going to start to taper, withdraw this liquidity. And the forwards are forecasting that you're going to start to see rates go up in the end of next year into 2023. Historically, that has not bode well for asset prices in general. So what we've done is with our managers, with our internal part, we've found managers that do very well in a downside market. When you look at the risk with our managers and what we do internally, a flat to a down market, we do very well. When the market does what it did last year, when it goes up 100% in 15 months, that is where we struggle. And so having these type of numbers in this environment, I'm really happy with what we've done, because our portfolio is not positioned for 100% return in equities. And you can see this on the first page, on the far right side, the alpha dollars, it's predominantly red. And as Josh mentioned, the one bright star was Arrow Street, their quantitative fund. They have by far the best performance that they've done over the last 10 years. So they really did very, very well. Conversely, Van Berkom, they're a value manager in a space where you had GameStop and all of these very low quality stocks that just ramped. And so the index went up significantly, but the value stocks vastly underperformed. So the big thing that we do, we look at all these managers, and what we do is it's like, well, did they perform the way we thought they were going to perform? And sure enough, other than, Arrow Street, which is a quantitative fund, it's a black box, you don't know what they're doing, but the other ones actually did. But the reason that I'm highlighting this is that in the event that we have the flat to down market, the managers, if they do what they say they're going to do and what they have historically done, we should be able to outperform versus the index. And that's obviously a very important part, is losing less money in a down market. So equities, I mentioned the alpha on that one was 45. Hedge funds, the same thing, both Grosvenor B and the internally managed Grosvenor C, we underperformed in that environment because the same thing happened. Chinese stocks, things like that have just ramped up. Conversely, like in July, when you started to see a correction in these stocks, Van Berkom was up 5% over the index in July. The hedge funds, we were up a little over 1%, because that has exactly happened. When you see the correction in some of these meme stocks correct, that is when they will do well. Then Opportunistic Fund, which Representative Schwartz mentioned. So those are the opportunities I just wanted to get into a little bit more, where we are able to go up to 5% of the fund, and we have a very difficult index because the total fund went up so much. But we had an opportunity to get into a different fund. For instance, Instacart. Instacart, during the pandemic, they were doing the home delivery of various things. They are supposedly going to do an IPO towards the end of the year. But we invested 15 million. So we want to have about 20 investments in this area. And we invested 15, and it's valued at about 40 million right now. Lineage, a cold storage business, same thing. They're a private company. They're going to do an IPO. Existing companies have a much, much higher valuation. So these are the opportunistic type of opportunities. One of the funds we invested with, it was President's Day holiday, and I got a call from Grosvenor on a Saturday afternoon, and they said, by Monday night, we have to know whether or not you can do this. So we spent Saturday, Sunday, Monday going through all the investments, looking at what they had. We came through, we presented, we said, yes, we want to invest. And so that's the type of thing that unless you have, that's the opportunity that we're talking about, where we can quickly invest in something without having to go through with the various, the IFCs and the SLIBs and getting the approval, which can take, multiple months. And so this is something that we're just at the embryonic stage here. We're going to grow this over time, but hopefully we'll be able to have that same type of return. The next page, real estate. UBS has been a problem. Real estate is a illiquid asset. We have been trying to redeem out of this fund for some time. They've been heavily invested in the real estate sector, which has been a thorn in the side. And you just get back as much as they can when they liquidate. So we don't know if this is going to be a 5 or 7 year or what it is. But that has been the big negative. One of the bright spots was real term. So as we're looking at these investments, we also have an opportunity set to say, what area do we really like? And we think that there's an upside. Real term is like the last mile. they do the last mile storage for all the internet and so forth. And so that was an area, as we saw with COVID and everything else, that this area should do very well. So this was another one of the investments that we put in and produced 14 million in alpha. Fixed income. As you know, fixed income is very problematic. When we're this low in rates and your spread product, i.e. corporate bonds, mortgages, et cetera, are very expensive, there's very little more upside that you can get by being overweight corporates and mortgages and things like that. So this is an area that has us worried. It's a very difficult environment. The way that we're looking to potentially produce alpha on that is actually on the short side. So when the Fed does start to hike rates, when they do withdraw the liquidity, hopefully that we'll be able to outperform in that rising rate environment. So as you can see, real estate, that was the 27 million that we outperformed, and 31 in the fixed income area. So with that, I'll stand for any questions you might have.
Okay.
Mr. Chairman,
Go ahead.
just a couple of observations that I'd like the committee to look at. When you look at, I guess, the whole picture of investing, that roughly 90% of your income, what you make, is in what you buy. That's your asset allocation. Right now, that's a purview of the SLID board with the basically the collaboration of the IFC in our office. But just look at the benchmarks, and you can look at those. They range from a negative 322 on a fixed income to a positive 66.34% return. So it really is what you buy, and that's 90%. Everything else that Patrick is doing is working on the margins to make sure that in each one of these areas, we're actually getting more than, or basically a higher risk adjusted return. And a lot of these, as he's saying, is that even in the bank managers where they're just marginally underneath, the bank managers were picked a lot on the number of loans that turn up bad, and so those numbers are underneath the benchmark averages. So we know that in this area, that when we come into anything that's going to happen, yeah, we may go down, but we're not going to go down near as much as a lot of the other people. So and that's where we really get the risk adjusted return, and that's where our shop really adds a lot to the whole overall portion. Granted, it's only 10%, but working on that 10% and doing that right really makes a difference. And to the one point that Senator Hicks brought up earlier, and that was on when you do your rebalancing, and take a good look at that RVK. We had been doing our rebalancing basically monthly, and we looked at it and we asked RVK to do this analysis. And essentially what it showed was that somewhere between 4 and 5 basis points, we had basically that was the cost of doing the rebalancing so often. But what we didn't realize is that we got another 45 basis points just because our investments were invested longer. And so we picked up a lot more gain. We picked up probably some more dividends. And when it was all added up, that was almost 0.5% more just by doing it, smarter, understanding that we saw the problems that we did have, and actually just, made that whole 0.5% difference in our portfolio. You take 0.5% over all of the basically permanent funds, that's a lot of money. And so what we're trying to do is work really smart. Patrick really looked at the income part of it and getting that other 46 million a year. If we do something on 121, so we can do that total return, then that's going to make a lot of difference to education. And incrementally, looking at every one of these things, it added value and taking away the risk is really where we're focused at. And it's moving in the right direction. And you can see the Sharpe ratios have gone in the right direction. And if you look at what was done 19, 15, 10 years ago, you can't hardly compare anything that we're doing now back to those days, because the asset allocation is so different. What Patrick is doing in his shop is so different. What Katie is having to do in her shop is so different than what it was even 3 years ago. So things are moving quite quickly, I think. But we're taking the time to do it as basically as right as we possibly can. And thank you for your guys' help.
Questions? Thank you, Patrick. So next on the agenda is opportunity costs. Have we got anything more from Josh? Anything more on this subject? Performance update? Don't believe so. So next, opportunity cost, LSO and Polly. And this is the second to the last document in your folder. What have we been missing, Polly?
Just a minute and I'll tell you. Karen, should I plug into this? Okay, okay. Thank you, Mr. Chairman, and I'll get my screen up here, and you all have a hard copy of this in your notebook as well.
Starting to make a list of what we need to do for directions. Primarily on 121. No, that's what I got. And identify the hurdles.
There it is.
Statutorily, constitutionally, what we need to fix.
Are you ready?
Absolutely.
Okay,
Throw it.
awesome. Yeah, thank you for saving me for last. And this is a project or a request that the Select Committee had at the last meeting in May. You asked your LSO to provide an opportunity cost analysis of the difference between the investment portfolio that we have compared to other choices, and specifically request that the Chief Investment Officer determine what we would compare our opportunity costs to. So I'd like to thank Chief Investment Officer Patrick Fleming for picking those comparator portfolios for us, and also for making RBK available to provide data so that we could do this analysis. It was a very important collaboration. The opportunity cost is simply the difference between what we invested in compared to a different choice that we might have made. And the comparators that we're using for this analysis are a portfolio of 60% global equities, 40% US fixed income as one comparator. And then the other comparator is median performing large endowments and foundations. And by large, we mean assets of over $1 billion. We go over the period between 2002 and 2020. That's the time frame we're looking backwards at. And this paper has a lot of charts in it, so I've really kind of focused on putting the charts up on the screen. And we're going to start out looking at figure 1A, and the analysis concentrates on the state's two big portfolios, the PWMTF and the CSPLF. So first, we're going to look at figure 1A. I've got it up here on the screen, and it's the hypothetical dollar value of returns for the PWMTF versus the comparators over the 19-year period in this analysis. The upshot of what this shows you, if you look at those lines and you look at the difference between those lines over the entire 19-year period, the hypothetical opportunity cost of the PWMTF compared to the 60/40 is an estimated to be 340 million. And compared to the large endowments and foundations, it's 2.028 billion. And that's what those lines tell you. Now, just to back up a little bit and explain how we got that. We took the value of the corpus of the PWMTF for each of those years and multiplied it by the return, the actual return for the PWMTF, and then the return for the 60/40 and the return for the universe of the endowments and foundations, and RVK provided that data. The return information is all gross of fees. We excluded the public purpose investments, and we did not make any cash flow adjustments. And so that, just to emphasize, this is a very hypothetical analysis, because this is also assuming that we're liquidating all the gain every year and showing you each one of those bars on figure 1A is the dollar value of the return each year. And then when you look at the lines, they're.
Mr. Chairman,
Go ahead.
just a quick question, Polly. And
Yes.
the reason for the 60/40, I thought the statute we adopted was a 70/30 reference portfolio.
Mr. Chairman and Senator Kinsky, that was recently changed with the Senate File 121 to the 70/30, but I think CIO Patrick Fleming picked the 60/40 because it's more reflective of maybe where we had been,
Okay,
looking
thank you.
backwards.
Thank you.
Okay. Okay, so, the lines show you the difference between the cumulative return at any point in time and the difference in the lines. And the blue is the PWMTF, the orange is the 60/40, the yellow is the median for endowments and foundations. So you can see most of the opportunity cost is really comes out more when you're comparing to the endowments and foundations. And then just to scroll down and show you figure the same analysis for the CSPLF. It's a smaller portfolio, so, smaller corpus. So those bars are all smaller, but it's basically the same pattern. And yes.
Go ahead.
And so it's the punch, as I'm looking at this, the punchline, the opportunity cost is the difference of the delta, the difference on 1A between the 7.198 billion and the 5.517 billion.
Mr. Chairman and Senator Perkins, you got it. Yep.
Okay.
That gives you the $2.028 billion over 19 years. Little technical thing is that the endowments and foundations didn't have any comparators in the first year. And so it's really 18 years when you're looking at the endowments and foundations. So
Okay.
punchline, that's it. And then when you go down to 1B, that same punchline is that for the CSPLF, the 60/40, the estimated opportunity cost there is 130 million. And then for the compared to the endowments and foundations, it's 628 million over that period. So in general, looking backward, Wyoming's permanent funds tended to perform better in broad market downturns and comparatively worse in rising markets. And you can see that when you look at, particularly when you look at the down market, the bars that are down. And the charts are very similar in pattern, but Wyoming's portfolios did better against the comparators in the years when there were downturns in the equity markets. And that's because we were less in equities.
So based upon that rationale and based upon the fact that we're at an all-time high in the market, our current portfolio, if we have any type of correction in the next 2 years, is going to outperform the E&Fs probably. Is that fair?
Well, Mr. Chairman, I think this is backward looking. And the portfolio is changing and evolving, and I think it is going more in the direction of being more in equities. So that might be a better question for our CIO, but this is backward looking.
Yeah, and he's shaking his head.
He's shaking his head.
No, he's nodding his head.
He was nodding his head.
Nodding his head, he's not shaking his head.
Well, I can shake it this way.
So that's yes, I am, and no, I'm not.
So I guess the point is the timing of it, to go to a total return, it's probably not the optimum time, or it won't hurt us if we do this gradually. Is that fair, Patrick?
Sure, absolutely. And that's part of the pacing schedule that we're doing. We're not doing this increase in risk immediately. It's paced over the next 5 years. So, and then some of the risks that we're taking is risk in fixed income. For instance, how we define equity would be a levered fixed income fund that will be better. Will not have as much downside.
And Mr. Chairman, another thing, the pacing schedule, a lot of things are privates. So you don't want one vintage year, all your eggs in one basket. Too much cash trying to chase these different types of opportunities. So you pace it out so we can stay on the top quartile as far as privates. Spread it out over several.
Okay, Polly, go ahead.
Mr. Chairman?
Oh, go ahead.
So while we're at this pause, just wanted to see if I'm understanding this right. So if we move towards a total return and we start to remove some of the drags that we have from various statutory or even in some cases constitutional drags that are in these, we would move more towards what the total, that light orange line is that, I mean, that's the whole point, right? That's what we're talking about.
Okay, Mr. Chairman, moving on to the next set of charts in the table, figures 2A and 2B, again, PMTF, CSPLF. This is a picture of volatility in dollars. So Josh from RVK was talking about volatility in terms of the standard deviation, which it is, but here's another way of looking at it, which is in dollars. So, you know, what this shows you is the maximum upside and the maximum downside for each one of the portfolios. The bottom one is the PWMTF, then compared to the 60/40. And then for the endowments and foundations, we presented here not only the median, but also the first quartile and the third quartile. And what you can see is that the 60/40 had a lower downside and a higher upside than the PWMTF. So, you know, there's just kind of a picture of the maximum upside, the maximum downside. Again, hypothetical, because we're not really liquidating each year. And then for the CSPLF, the same thing here. And, you know, what you can see here is that there is a lower downside and a lower upside for the CSPLF compared to all other portfolios. And that really kind of demonstrates the income-oriented nature of that portfolio.
Well,
yes,
Mr. Chairman, and I mean, it's not just that, but it's also the fact that constitutionally, it's kind of, we're required to kind of be in that space more than if we started to move towards the ENF. I mean, it's some of that is not just, it's not just that that's what's invested in, but we kind of sort of have to be in that in some respects because of the constitutional constraints, particularly on the common school permanent land fund. Is that accurate?
it's the investment policy statement clearly states an income focus, and I could probably let our attorneys speak to the Constitution.
I'll answer that. Yes.
Mr. Chairman, is there a question there? I mean, we're happy to answer.
Yeah, I mean, ultimately, the Constitution particularly in the common school permanent land fund, it's talking about rents. I mean, it talks about income, it talks about income. And so, I mean, the Constitution prevents us, the Constitution in its current form, in my mind, would seem to prevent us from moving in the direction of trying to go to a total return for the common school permanent land fund because of the current provisions of the Constitution. Isn't that accurate? We got it's rents, royalties, dividends, and interest.
Yeah, Mr. Chairman, I think that's right, and the only thing I would add is, the limitations in the active admission as well.
Yep. Okay, thank you. And one other question, when you, in your research, when Utah went back and redid their constitution a couple of years ago, they actually went back and got Congress to change it to amend their active admission so they could go in the direction they wanted to. That was one of the things that they did, wasn't it, as they did their reformation?
Mr. Chairman, I do believe that's correct, is that they amended the active admission to reference the management of the funds in accordance with whatever they put in their constitution.
Right. Thank you.
Moving on to the next set of charts, really just isolates the opportunity cost for each corpus relative to the comparators, the 60-40, and then the endowments and foundations, but also showing the first quartile and the third quartile. There has been opportunity cost relative to the comparators for both the PWMTF and the CSCLF. The investment results would have been better if performance had been at the 60-40, and even better if investment results had been along the lines of the median or higher performing endowments and foundations. But it's also important to note that Wyoming's portfolios did better than third quartile or lower performing endowments and foundations.
Mr. Chairman,
Go ahead.
I've got the blue, the orange, and the yellow. What's the gray bar?
Those are just different timeframes. So yeah, it's over 5, 10, 15, and 19-year period. And so it's kind of interesting because in the longer dated timeframes compared to the 60-40, the opportunity cost actually drops for Wyoming's portfolios. And that's, again, due to those down markets when we were invested more conservatively than the 60-40 and didn't take as much of a loss. So the gray bar is the 19-year period, the orange is the 15-year period, the blue's 10 years, and the yellow is 5 years. And then for the different comparators in this one.
Okay. All right.
Yeah.
All right. No,
And
all right,
again,
gotcha.
I was just pointing out that Wyoming's portfolios in general did better than the lower performing endowments and foundations. And then the same thing for the common school. It's very similar patterns for both portfolios, which really leads you to want to know more about how those endowments and foundations are investing. And we don't have a lot of information about it. And but table 1 here shows you the asset allocation or the median allocation by asset class for for a 15-year period. And what it generally shows is that the endowments and foundations are increasing their allocation to alternatives. And by 2020, they have almost 58% in alternatives. They're decreasing their allocation to fixed income, and they're decreasing their allocation to the public equity of US, or whether it be US or global. They're decreasing their allocation there. So they're really going more into alternatives. And then the last chart I have for you is on the Sharpe ratio comparison, which Josh has already really nicely explained. The Sharpe ratio is a measure to evaluate how much return a portfolio is getting for each unit of risk. A higher Sharpe ratio is desirable. And so this shows the Sharpe ratios, and RVK provided all this information over 19, 15, and 10 years, the Sharpe ratio of the Wyoming's portfolios versus the 60-40, and then the median of the endowments and foundations. And Wyoming's beating over these timeframes, looking backward, Wyoming's beating the 60-40 but not beating the endowments and foundations. So had Wyoming followed the 60-40 investment results over this period, the return would have been higher, but the risk adjusted return would have been lower.
Mr. Chairman?
Go ahead.
So, Polly, on figure 4 in the Sharpe ratio comparison,
Mhm.
whether we got the Sharpe ratio and we have them at percentages, but I thought in our discussion with Josh is like the best Sharpe ratio was 1.
You're right.
And so it's not
Right.
really a percentage. That's actually the Sharpe ratio.
Right. My apologies that there shouldn't be a percent. There's really just a
All right.
ratio.
All right. Thank you.
Yes. Yeah, so however, when you compare Wyoming's portfolios to the median for endowments and foundations, the results would have been better both on an absolute basis and on a risk adjusted basis.
So I have a question on the,
Yeah.
using the median endowment and foundations returns.
Mhm.
And Patrick, this is probably for you. I mean, that, my guess is that's a pretty wide spectrum of high performers, medium performers, and low-end performers in the endowment world. Is that? I'm just guessing that, but I'm asking that question. What's your understanding of that?
Mr. Chairman, that Polly mentioned before, that was the billion and above, correct?
Yes.
In this, so it
Yes.
does take the lower foundations and endowments out of it. So this would be I think a relatively good subset to look at when you're comparing the difference.
What I'm trying to get to is, what if you took the top quartile of those performers? Then this would probably be, you'd add another $1 billion into it.
Oh, absolutely.
And I think
Yes.
we have that.
And
Yeah,
Ms.
so, I mean, just to put a finer point on it, so let's just say you're in the top 50%. The top 50% are performing endowments and funds in excess of $1 billion. What does that do to the chart?
Mr. Chairman, I mean, I have the top quartile, which is the top 25%.
Okay,
And so, instead of the 2.028 billion over 18 years, it's 3.848 billion over 18 years.
say that
So that's
again.
back on this page.
Is that back one page?
I have it up.
It's over in figure 3A. Are you taking
Yes.
us back to figure 3A?
Yeah,
So we can pull that out.
in your median.
So that doesn't, yeah, that shows us the
Here's your median.
opportunity cost relative to the portfolio. It doesn't show us the chart, but it shows us, it's the same type of information you can kind of sort of interpolate.
I'm sorry, Mr. Chairman, I missed what you were saying.
That's okay. I was just mumbling, so I don't even know what I was saying, but I mean, the figure 4, which is Sharpe ratio comparisons, when we go back to 3A, then we're actually looking at opportunity cost, which is what we could have done better, but it kind of makes the same point. I mean, ultimately, it's the same type of trend. We'd seen the same type of results. If we look at the 3rd quartile ENF, is that what we're looking at? Are we looking at, we're looking at the 1st quartile ENF?
Right, the top quartile would be the top 25%. I guess median and above would be the top 50%.
And that's when you say the top 25%, that's the 1st quartile ENF, right?
Yeah.
Okay, I'll make sure.
Yep.
All right, thank you.
And just to follow up on that, those funds, we kind of know what those are. They're the totally independent, typically. New Zealand, what are,
Norway.
Mr. Chairman, Mr. Vice Chair, no, that would be a sovereign wealth fund.
right?
So the endowments foundations would be your Ivy League types of, like, you always hear about the Yale fund.
Yale, Harvard.
Yeah, those would be in that category. And just to be clear, when you were talking about orange, I just want to be very clear that we're talking about the endowment and foundations, not the burn orange. When you asked me what color that we were alluding or trying to get to. Because those two
You're right.
colors are, I just want to be very clear. We're trying to strive towards the endowment foundation, not the 60-40.
Right.
And as Senator Kinski mentioned, the 70-30, you could just take a shift that 60-40 up, and 80-20 would be higher, 90-10. It's purely on the amount of equity and private equity that you own.
No, but
And where that return-
No, and I get that, right. it's the it's the 7.2 billion versus 5.5 billion on figure 1A.
On page 207.
Yeah.
It's the 5.5, not the 7.2. The 7.2, I'm sorry, no, the median ENF, the 7.2, correct.
Yeah,
is
so I
what
mean,
we're
that's,
striving for.
I mean, that's the opportunity cost between the 60/40 and the median ENF is the difference between 7.2 billion and 5.5 billion. And the cumulative return in billion.
Correct, because it has a high return and
the-
higher Sharpe ratio.
Yeah.
But as I point out, which I mentioned before, just to make sure everyone understands, these funds are inviolate, do not have the inviolate structure. So it doesn't matter if you have a big drawdown or what have you, they just liquidate with the funds and spend whatever they need. So ENF funds do not have the inviolate structure that we have. So that's another issue which we talked about that would preclude us, even though we would wish to go for that. And the other need is because of the interest income dividends and so forth, we have to have that no matter whether it's common school or what have you, because we have to run the state. So we have to, when we go through our asset allocation, we have to have interest income to be able to pay for the funding of the state. So that even though we're striving for this, we will always have a much higher percentage of fixed income because of the needs of the state, and unless we can change.
Well, right, unless we change the total value.
Absolutely.
And so, Mr. Chairman, I mean, but the other point of that is also on, particularly on the endowment funds, and the fact that they're not inviolate, actually, when they have downturns and they're invading their corpus, it makes it longer for them to make it back up. So actually, while we may create some kind of a drag, we also have a protector on the bottom, because if ultimately, if our funds remain inviolate, regardless of what model we go to, and I think that's always been the intent of anybody I've talked to about this, is that, you know, we smooth out the lows. We may end up impacting the highs, but we smooth out the lows a little bit because of if we have inviolate safeguards, if they're maintained.
Mr. Chairman, that's spot on. In Colombia, there's a great case study just looking at the great financial crisis. They had a tremendous amount of alternatives, very illiquid, right? So when we had the great financial crisis, they had to fund the university, scholarships, everything else. They were selling hedge funds and other privates at 50 cents on the dollar to fund these because they didn't have the liquidity needed. So those are the instances where at just exactly what you mentioned, the highs and the lows, it took them a tremendous amount of time to do the catch up because they were selling distressed assets. They didn't have fixed income US treasuries to liquidate to pay for the fund. And that's where our reserve accounts are so important, or having the ability to spend that.
Well, then your opportunity fund can buy those distressed assets on the fire sale. So anyway.
That's our opportunity fund. Absolutely.
Mr. Chairman, and something I think, you know, we're wanting to have, you know, that foundation endowment thing for some flexibility in spending policy. But I mean, look at 3A, and just because there's a different structure doesn't really necessarily say you're going to have returns, because if you do a good job in your first quartile, you'll have good returns whether or not you're operating in our structure or an endowment or a foundation versus someone who's in the third quartile. So the whole thing that you really have to strive for is doing the best job that you absolutely can, because necessarily it's the performance is driven by asset allocation and what you do with the asset allocation. Because you can go in privates, but if you buy third or fourth quartile privates, you're not going to get the performance. So it's just how you do your job really is how your income and how your performance runs.
Right, and this whole discussion is about how do we free up your office to go do the best job they possibly can. So, you know, are there statutory, are there legal impediments to allowing you to do your job? And that's what this whole exploration of the 121 is all about.
Yeah, Mr. Chairman, I think there are some impediments there. but I think that we can free up, and have a lot more freedom, but still endeavor to protect our corpus, because I think there's a big, we got billions of dollars over the corpus right now that we free up, try to put that into an operable reserve, invest it the same way that we do the rest of the corpus. And I think that we can get that freedom. It's just trying to get the right language.
Mr. Chairman, and I think that was really beneficial having Angela here and talking about the structure of the Alaska Fund, which has kind of keeps, they've got their corpus, and they kind of, not really, but they kind of sort of keep it separate. And then they have, it's got an $80 billion fund for those that weren't there at Saratoga last week. Alaska's got an $80 billion fund, of which kind of basically 50 billion was in the corpus, or the corpus fund, and then their reserve account, which is where they kind of harvest this stuff off. They don't spend it all, but it's in the reserve account, and there's 30 billion in the reserve account. But it's still being invested, or big chunks of it are still essentially invested as though it was part of the original of the initial of the 50 billion corpus fund. So I think we're that's kind of what I'm looking at and looking at, as somebody else has kind of already gone down this road a little bit.
And that's similar to New Mexico, isn't it? I think New Mexico has that same concept.
Yes, they also freed it up. I believe their funds are not inviolate. I think they have a different structure. I know they have a different structure. I don't know all of it, but it would be slightly different than what we're talking about. And just as a follow-up to the treasurer, it's a great point that he mentioned on this first quartile. As Paulie mentioned about the 58% in alternatives, many of these funds, like what Yale invests in, are closed. So you have the first quartile funds, but you can't get into them. So that's the other thing that is very difficult to get into that first quartile, when the funds that have done very well, they're not open up for investments. And so that's the other point that Representative Nicholas made, is that you strive for the first quartile, but even if you have the ability to do so, it doesn't mean that you necessarily can, because a lot of these funds are closed.
Go ahead.
Thank you, Mr. Chairman. So on that note, Patrick, I assume there are occasional openings in a lot of these closed funds. Is that a question of contacts, so that when they do have an opening, they're going to come to you rather than go to Alaska to offer the opportunity?
Mr. Chairman, Representative Schwartz, that is a great point. And one thing, Institutional Investor just named the state of Wyoming as one of the best turnaround stories in private equity. So I want to give the treasurer a lot of credit here of what he was able to do, and all of you for allowing us to hire people to do this. So what we've done in the private equity side is we actually go out to these closed funds and start marketing them. And what they do is they look at it and they say, hey, state of Wyoming would be a great partner. It's steady money. They're not going to be coming in and out. And so that is what Matt Smagash, who runs a private equity fund, that's what we do. We do it with all funds that are closed.
Mr. Chairman. So, and also going back to was it Columbia, you said, or Columbia that had to do the sell-off?
Correct.
I mean, if they're looking to sell positions in closed funds, so because they need to raise capital, I mean, can they then, is that another way that you can actually participate, is if you buy, and if the closed funds know you're interested, that then you can substitute in and buy out a position if somebody else is trying to liquidate out for whatever reason?
Mr. Chairman, that's typically in the distressed category. And so we did not have a private credit availability until what was just passed recently, another part of our asset allocation change. And so in the next downturn, there is going to be a lot of opportunities to do this. Now, if it is a overnight, a weekend, like I alluded to, position, we would be able to put that into the opportunistic fund. If it is a fund that's raising a couple $2 billion, then we would be able to invest into a distressed fund that would take advantage of exactly what you're talking about.
Yeah, it takes Matt 2 to 3 years cultivating and talking to these people every month. They know who he is, and he's really starting to get into that crowd, the people that that know us and know him. So it's, what he's been able to do has just been very, very persistent. And so he's getting in those areas, that dabbling a bit on the side of venture, which is one thing that Yale has. I think more than 50% of their fund is venture. We necessarily don't have a asset allocation class for venture. And we did years ago. And I think that one finally, what, Patrick, it's finally, Mendocinos is finally wrapping up after 20 some years. So you have to be really, really, really careful about jumping into these things, because you want to get in on the top tier, and most of the times that they're closed off, but Matt has made some inroads into actually being able to cultivate those contacts. And so it's an exciting time for Matt. You need to have him talk to you, because he gets really excited about it.
Okay. Where are we, Polly?
Mr. Chairman, the only other thing that I just wanted to maybe wrap up with is just to tell you a little bit more about the peer group that we used. It was from Investment Metrics. RBK obtained the data on the endowments and foundations. There were 347 funds with assets $1 billion or greater. And they were all entities classified as an endowment or foundation. And we although we were able to get the information on the asset allocation, we do not have any information on the spending policies or other practices of these entities. And that's all I had for you.
Okay, any further questions on this issue? If not, I think we're going right to the next one, spending policy.
Okay. Okay. Mr.
ahead.
Chairman, okay, thank you. You all have in your packet, I think it is the very last thing, the preliminary or estimated spending policy results for fiscal year 21. You've already gotten a lot of preview information on this, and so it's, as you know, it's a good year for Wyoming. The investment earnings in all of our funds met or exceeded the spending policy amounts. So investment earnings have been strong compared to spending policy amounts. And we're going to be seeing, as I walk through the flow charts for each of the 4 permanent funds, kind of increasing reserve accounts and in some cases estimated corpus tips. And I want to also just remind you, this is preliminary information. The State Treasurer's Office has by statute 90 days after the end of the year, which is September 30th, to finalize everything. So we'll come back to you at your November meeting with the final results. So starting with the PWMTF, we have the corpus there and the 5-year average, which was what everything is based on. And the State Treasurer's Office staff has let me know that they have completed the yet to be distributed amounts. And so these charts were done at a time when that was not yet done. So we had given the information based on what was completed for distributions in the state's accounting system, WOLVS, and also what was expected once the yet to be distributed amounts were completed. And that has been completed according to Katie Smith and Don Williams. And so I'm going to be going off of those numbers. Also on the charts, the red elements on the charts indicate changes that were made by Senate File 121 that passed last year, just for your reference. So for the PWMTF, the investment earnings for fiscal year 21, $492.4 million. Our 2.5% spending policy for the general fund is $194 million. There's adequate amounts above that to put the 1.25% into the SIPA and also 1.25% into the LISRA, 97 million each. And then there's going to be money moving into the reserve account. And we're estimating that that reserve account balance is going to be 419 million once that money flows in there. The cap is 150% of the spending policy amount, which is 582.1 million. So we're still not up to that cap. So we're not estimating a tip to the corpus. And then moving on to,
I'm not sure exactly how much is going into the reserve account.
okay. It's going to be the 69.2 plus the additional 35.2. So that is 104.4. They'll be going into the reserve account. So last year, our balance at the end of last year was about 306 million. And so it's going up quite a bit. And the reserve account also gets to keep its own investment earnings. And so if you look in the first asterisk at the bottom, you can see that investment earnings on the reserve account were 7.6 million. So all of that is going into increasing the balance from what it was last year, which was 306 million to 419 million. Shall I continue?
Please.
Okay. Moving on to the Common School Permanent Land Fund. You can see how we, use the corpus value here. We've got 4.1 billion market value, and then the 5-year average 3.9. The investment earnings 233.4 million. That does include a small amount for the Common School 2 account. It's not a lot, but it is in there, and so that will be an adjustment that we make. The spending policy amount for the school foundation program is 5% of the 5-year average of the corpus. That's calculated to be 196.1 million. So that the investment earnings has, more than met that. And so we're going to be seeing money flowing into the reserve account. The cap on the reserve account is 150% of the spending policy, 294.1 million. We're estimating that the reserve account, after all, distributions are finalized, is going to be 312 million. So we are estimating a tip into the corpus of 17.9 million. And again, I do want to just always remind everyone, this is preliminary and there can be some changes.
Mr. Chairman?
Yeah.
Please.
And Paul, I guess we do this, the CAPFIN committee does this every year. It's a general letter that we do statutorily to alert other people about what the effects of the last fiscal year were, correct?
Mr. Chairman, that is correct. And by statute, the select committee reports to the full legislature prior to the convening of the session on the status of the spending policies and any changes that that the select committee is recommending or moving toward. And so we'll also be bringing that at the November meeting for your review on that. Where am I here? So next is the Excellence in Higher Ed Endowment Program. And what we're seeing here is that the investment earnings, 7.1 million on a portfolio of a corpus, it's almost 120 million. And the spending policy amount is 4.75% of the 5-year moving average, and that's 5.7 million. If you look down at the bottom, you'll see in red that the SPA is going to increase next year to 5%. And so the investment earnings, more than met the spending policy amount. We're going to see money flowing in to the reserve account. The cap on the reserve account is 150% of the spending policy amount, or 8.5 million. So we are estimating that we're going to be up at that cap. 10.6 million was already tipped into the corpus, and that was really more due to last year, but it happened in fiscal year 21. And then we're estimating another tip of 1.5 million for fiscal year 21. And then that leaves us with the Hathaway. And the Hathaway had investment earnings of 32.1 million. The Hathaway does not have a percent spending policy. The spending policy for the Hathaway is the amount needed to fund scholarships for eligible students. It was about $18 million this year. So the 32.1 million has been adequate to meet that. So again, we're looking at money flowing into the reserve account, about 15 million flowing into the reserve account. The cap on the reserve account is either the greater of 12 million or 4.5% of the 5-year average value of the corpus. So we're calculating that to be 26.3 million. So we are going to be up at that cap and be looking at a corpus tip of an estimated 14 million. And that is everything that I had on the spending policies.
Well, any questions for Paul? Let's see, we're moving into a Friday afternoon. Thank you, Polly. Okay, that concludes our presentations. Now, I think what we need to do is go back to our agenda and talk about any directives or issues we need to work on before our next meeting or just moving forward. And Mr. Co-Chair or Mr. Chair, I think I'll turn that over to you.
Well, thank you, Mr. Co-Chair. The couple of things that came to mind is on the in-kind transfers that we've made. I think we just a little bit more work to do, and I did send an email off to the state auditor, and we need to figure out a little bit more about all that. You know, it's a valuable tool. It's all about making sure that we understand the effect, understand what that is, and if there's something we need to do on a policy level, we need to do that. So I've asked the auditor to send me the audit findings, and we'll share those with everybody, and then with Bob and I. And then I think at some point there, you know, at least Bob and I and somebody else, we may try to get folks from the treasurer's office, folks from the auditor, and folks from the outside auditor's office all in a room at the same time and kind of hash out and make sure we're all on the same page, so we're not any cross purposes moving forward. So,
well, and even
I think that's just a little bit of, that's just, I don't know. I think the only staff direction is that let's let them know we're headed in that direction. And so we'll follow up on that, and then we'll report back to the committee on just to keep everybody informed where we're at.
And Mr. Cook, I'm also wondering, you know, Patrick says that everybody or a large percentage of the investment funds do this. The question is, what we probably need to answer is, do states that have inviolate or constitutional funds like we do it? And if they follow that same practice, or if not, or if they do, how do they get around it? So I'm wondering if perhaps you could have someone look into that to some degree, so we have a better understanding of how the state sovereign type funds that might have different types of restrictions than trading funds handle it. I think that would be useful. And if they do have restrictions on it, how they handle it, because it could be as we move forward with Senate File 121 statutory changes, we can incorporate it into it if we need to. Go ahead.
Josh Keaton is still on.
Okay.
He works with these entities. Might be able to answer.
Okay. Yeah. In fact, I wanted to ask you that, Josh. I didn't realize you're still there. Maybe he's not still there.
Mr. Chairman, I'm sorry, I did have to step out briefly, but I just walked in as I heard my name. So I'm here, happy to answer any questions, but I didn't happen to hear the question.
So the question, Josh, was that, as you recall, when we had the early discussions, that Patrick indicated that a lot of the investment houses do the in-kind trades on a regular basis. And my question was, do state sovereign funds and constitutional funds similar to ours do in-kind trades, similar to all those investment houses that he talked about? And if they don't, or if they find a mechanism around it to conduct those in-kind trades, and if we might look to them and see if there's any statutory changes so if they've already gone down this path to facilitate us addressing that issue.
Mr. Chairman, of the funds we've been studying, there are a wide range of arrangements, and some of them, many of them, in fact, don't have as many different pools as you do. Some of them, such as New Zealand and Alaska, have primarily one fund that they are managing. So this issue of in-kind trades between accounts really isn't going to be as relevant for many of them. And many of them also don't have this concern for the accounting treatment of, if gains are realized, unrealized, or if it meets the definition of income that you do. So I think you do have a somewhat unique set of circumstances. And to the extent that there are other funds out there that do have this opportunity to save money by crossing trades, which is what this is, with these in-kind transfers, I would imagine if they can do it, they're doing it. Now, I'd need to do a little bit of research to be able to answer that question definitively, but I would be quite surprised to find that anybody that can do it isn't doing it. It makes a lot of sense from a maximizing the value of the assets perspective.
So, and to follow up on that, Patrick, have you done a calculation of what we saved through your in-kind trades last year?
We have not done a calculation on it. Very depending on liquidity, like during COVID. It offered in treasury, it's only probably so it depends on where transfer bank loans.
So is it something that you could do? So we could, or at some point in time in the future, I mean, it might be premature right now.
I can look at it.
I just think it would be a useful bit of information for us to know.
I don't know that
Okay. Go ahead.
So anyway, and then we get down to the 121 and the specific request from staff that we give them some direction. And Mr. Chairman, I think what would be helpful is, one of the things that we're looking at is, one of the purposes of 121 is, quite frankly, was if we can move to a total return situation, then what we have to do is we've got to remove some of the statutory, and in some cases, even look at the constitutional impediments to doing that. And so we kind of preliminary had that discussion today. And I think to take this to the next level, I think that one thing that would be helpful to us as a committee is potentially if we took, I was thinking 2 funds, Mr. Chairman. I think we take one, the PMTF, and then another one, and I don't know, it could be a common scope land fund, but something with legacy assets where we have, like, for example, in some of the permanent land funds, we've got assets that were contributed at the time the state was created. And so, and those might be the 2 examples, but we take just those two funds, and we do a draft bill, and it's just for discussion purposes. Because that's kind of what we're familiar with, and we can kind of look at what those changes would be. And we look at, so we end up with this, a draft bill. So take the permanent trust fund, permanent trust fund. And like I say, one of the legacy funds, and let's go through the exercise of what statutory and constitutional changes that we would have to make. So statutory changes we can put into one bill. If there's another one, it's a constitutional amendment type of a bill, and see what we would have to do, what it would look like if we were to move in that direction. And so I think to do that, and if we're going to talk about that, the things that we would need to, things that staff would need to take into consideration are changes to statute, potential changes that we have to have the Constitution. And I'm just thinking if we break it down those funds, we can just really get down to the brass tacks and see what that would be in that instance at least. I think that we'd have to come up and we'd have to define what the corpus is. We have to find a strong definition of corpus, because these funds have inviolate corpus clauses, and I don't want to do away with those. I think that has to be in effect. And then I think that the last thing you have to do is you have to look at the structure of the reserve fund. And I think initially there may be a different way to do it, but my thought was maybe you look at kind of the reserve fund like Alaska has with their big fund, and now they've got that split off, and it's still a reserve fund that has different purposes for it. But right now it really is just a big holding account of what's been harvested off the corpus, and helps you kind of keep corpus and the rest of it separate among other purposes. But
we were going to go down that Alaska model and look at that reserve, I feel we have to incorporate the movie cap. Otherwise, it's just going to get back in.
yeah,
Do
and
we want to go all the way that far?
we've got to have that discussion at some point, because I really do think that what Alaska does is they simply appropriate back into the corpus. And so the question is, do you just leave it that way where you appropriate back into corpus, or do you set up some automatic tip mechanism? And we could have that, this will set it up and we can have that discussion.
Mr. Chairman, why, if you're going to go to a total return policy that allows you to in years where you're below your 5% to dip into corpus?
No,
No?
it doesn't allow to dip in corpus. That's the.
You make your
corpus is-
reserve account large enough that it covers that obligation. And well, in Utah might be, I think it's Utah, Patrick, that they have their corpus and the reserve account basically in one account, and they just separate them on the spreadsheet, right?
Mr. Chairman, by doing that, you would not need.
Yeah.
Because it's all one. You can have it to smooth the transition.
Yeah.
There is no need for a reserve.
I think that's technically right. I just think we need training wheels, and I thought I'd use the reserve account as training wheels for us while we work through this thing. Because it's new ground, and it makes me really, really nervous. So I think we ought to have a reserve account.
Well, and part of that analysis needs to be how and what we can do to enhance the size of the reserve, of that reserve account, because it needs to be 4 times as large as 10 times as large as it is now.
Maybe not. I think right now it's just create the structure, and we can talk about that. And I think that's the other part of the help we need from staff is maybe look at and brings back some information about, maybe look at Alaska, maybe look around at some of the other sovereign funds that, folks that have moved towards total return. And let's look at, I think they still have reserve accounts. And so let's look at their reserve accounts and give us some information about how they're structured and how they work.
And I think when you tag into that on a definition of the corpus, depending on how you define it, could enlarge faster and increase the size of your reserve account.
And so I think I think if we got that, it'd help us have a really good, robust discussion next time, and anybody who's paying attention is interested can weigh in on that too. And whatever we do, we want to circulate your office, because we want your office's comments as well, Mr. Treasurer.
Yeah, Mr. Chairman, one of the things that New Mexico did is that they did put the spending policy, a cap in the Constitution. And I think that would protect the reserve account or the overlay or whatever you want to call it within a separate fund from being rated or encumbered or different things like that. And I think that's important to make sure that you have a viable fund for now and in the future. Because I'd hate to figure out somewhere where we could realize a couple $1 billion worth of capital gains. And then 5 years from now, when where the majority of you guys may or may not be here, then it evaporates, And so I think that would be something that you might contemplate as far as the constitutional provisions is basically protecting that functionality.
And I don't disagree. All I'm trying to do is get to a point where we have I think this will help focus our discussion. But I agree. I mean, it's, we have, that's one of the policy decisions we'll wrestle with. In Alaska, their now $30 billion quote reserve account is completely subject to appropriation. And it's been that way for a while. And so ultimately they seem to have anywhere from 3 to 8 or more special sessions years. They argue about how much they're going to take out of that account. Most of that has to do about their dividend to their citizens. But yeah, I mean, that's a wide open deal. That's Dodge City on Saturday night. I think we have varying degrees of comfort level on this committee about how much money we would make available to future legislators.
Mr. Chairman.
How much we would.
Mr. Chairman. So the end goal, this gets simplified?
Well, right. I mean, at the end of the day, I think the goal is, and why I think this is a really important exercise for us to go through is, if you go to total return, that gets way simplified. If you go to total return, this stuff on in-kind transfers, once we get them accounted for, right, doesn't matter. Whether or not how much income and how much capital gain you get in any given year doesn't matter, because what it does is it frees up Patrick and his crew and the treasurer's office to go invest at the best, within the guidelines that we've set for them. And the rest of us on the back end, it simplifies the back end that you're going to get X amount a year out of your spending policy to spend, as long as you're not invading corpus to do it.
So I follow that. So you end up with the PMT of corpus. You have a reserve account that kicks out a constant spending policy amount. As part of that, do you anticipate that we'll stop diverting and intercepting money?
That would be part of the discussion.
That'll be part of the discussion, and whether does that go in the Constitution or whether it goes in statute. Because, yeah, I mean, at the end of the day, if we leave this stuff alone and let it work, I think it'll be great. If we're always screwing around with it, we're just gonna create drag.
Well, and you'll have to stop diverting to build up the reserve account to do a satisfactory amount that we're comfortable we can safely operate.
Yeah.
I just haven't seen that operate that way yet. My confidence level that any legislative body is going to stop intercepting capital gains and dumping it into tranches and diverting and preventing tips. I mean, I'd like to believe we can do that by statute, but we seem to be able to change it by budget when the spirit moves us. So I think it's a noble effort and we should take a shot at it, but I'm just not very optimistic that we're going to change legislative behavior to try and grab onto as much money as they can.
Well, that's part of one of our jobs, because if we do this and then we do it right, we're going to have an extra $300 or $400 million to actually do something with. Initially, it needs to go into this reserve account, but at some point in time, it's going to make the whole operation of government more efficient, make more money, and help deal with our downturn in our incomes from the mineral resources.
So I look at this from a standpoint, if you have the adequate amount of money in the reserve account, you're just running a cash budget based on. So it's you could structure that in your reserve account. You're only going to be able to spend what's in there. And it moves us more in the direction of a cash budget than it does right now with whatever shows up, then we have a free-for-all on how to spend it. You're gonna know early on how much is available. You could set that spending policy on that reserve account.
I mean, you could do it. I mean, this is the discussion we have about the back end and like say at the end of the day, it removes any perverse incentive for any treasurer in the future to buy, sell, or trade for whatever internal purpose. They just go achieve the best return that they can within the bounds that have been set for them, and the rest of it, it's not their concern. They're not to worry about it. So it's aspirational, no question, but it's.
So is that helpful?
Mr. Chairman, yes, I really do think that's helpful, right? I mean, that's a very large charge, but at the same time,
We'll get to it.
you're right. Exactly. We've got our work cut out for us.
But that's why we're just gonna pick, I think you pick one, like pick the PMTF, and I don't,
Permanent land.
yeah, you might as well pick the permanent land fund. Those are two biggies. And let's
I won't
figure out
get
what it is if
anybody's-
we go in this direction, what that looks like, right? And so you can concentrate on that and not have to worry about the other 15 funds.
Yeah, I don't want to do the common school permanent land fund because I don't want all the school people here wondering what we're doing. with
Yeah,
their
that's a
money.
good point. Do this common school permanent land
Just stay
fund,
away
find
from
a
that,
different
right?
fund to do. I just,
Not
you
that I
know,
don't
this
like
is,
Marguerite.
anyway.
Well, Mr. Chairman, that makes good sense. Of course, the Common School Permanent Land Fund is within the Permanent Land Fund, if I'm correct. So I think we'll get in, well, that would necessarily require us to get into some of that, but I think that makes sense. That's also the thing that brings us to the discussion, that would bring us to a discussion of whether there needs to be active admission changes, which I think is a valuable exercise to consider. So, yeah.
Yeah. I mean, if we're going to go down this road, it would make sense that we would go down that road. Doc,
I really question whether we really need to do any of this stuff. I think the spending policy works pretty well. And I think the idea that this amount of money that goes into the spending policy, the realized capital gains, I think it's appropriately being assigned. I don't really know that we really need to do anything with any of this stuff. I'd like to hear why we do. Isn't this working just fine?
Mr. Chairman, I can take a stab at that, Tim, because it is very convoluted. And if you haven't been in these discussions for the last several years, and so let's talk about the diversification of our economy. That hasn't happened. We know now that our investment earnings fund 20% of all the cost of government in the state of Wyoming. And in lieu of the volatility that our staff continues to tell us that we have the most volatile income stream we've ever had, what we're trying to do is move that our investment earnings now pay for a larger percent of the cost of running government. In other words, we have to derive a higher return on that permanent Wyoming mineral trust fund. You saw the figures under the conservative estimates. By moving this direction, what we're trying to do is essentially what Alaska does. Is 50% of all their government's funded from their investment earnings. And so when I look at this thing, I say, look, if we truly have this volatile income stream that's going like this is a way to start to smooth the peaks and the valleys out. It's a diversification of our portfolio, but it's a diversification that we're potentially going to derive more benefits to be able to fund government with some consistency versus the turmoil of fluctuating commodity prices. It is literally, think of it as an economic engine that is going to generate more revenue for the state of Wyoming, which it will. So this is a reason I think it's a very interesting concept to go through that. If you could even do 2, 3, 4% more long-term, that's a substantial amount of money that we're not relying upon the energy industry and the vagaries of whatever the market is. So it could potentially provide some real stability to our budgeting process and programs that we're in the state of Wyoming. That's why I think we need to take a hard look at this.
I don't have any objection to looking at it. I just wonder whether it's going to really be necessary. It's something we need to look at an objective analysis. See whether they really think these things are gonna improve what we've been heard. So that's what I had to bring out a different point of view on this issue.
Mr. Chairman,
So you guys could think about that.
Mr. Chairman.
Go ahead.
And I don't disagree with you, Tim. One of the reasons we look at it and why we're looking at objective, I mean, that's what I think that's exactly what we're doing. If you go back to Polly's memo and look at the opportunity cost that we're losing by not moving in this direction, you know,
It's $3 billion.
it's $3 billion over the last 20,
Yeah.
$3 billion over the last 20 years. I mean, $1 billion here, $1 billion there, pretty soon you're talking about real money. That's what it is. And if we don't do, I mean, you know, it's not up to us, it's up to, you know, if we think it's a good idea and we go forward, then it moves forward. And it moves the full legislature, we don't get to make the decision. We just get to see if we think it's a good idea and if we move it to the full legislature.
But Mr. Chairman, the opportunity cost thing, I'm still not fully convinced. That was comparing a 60-40 portfolio and also our past management of the portfolio with these endowments, but we're moving towards an endowment type model. What aren't we now?
Oh, exactly. I mean, but
So we don't need a bill to get there. We've already made all those necessary
no,
moves.
we haven't. I mean, to do what we got to do, particularly with the Common School Permanent Land Fund, we have constitutional and statutory barriers that prevent us from doing that. And so if part of this process, particularly with the Common School Permanent Land Fund, we actually have to go change the Constitution.
Okay.
To do that. So that's why we just can't, we're closer. But I think one of the discussions we've had both with LSO and with Josh is in particularly with this Common School Permanent Land Fund, we're pushing the envelope now is on constitutionality. And we've gone probably as far as we can go, if not a little bit too far, and particularly in the Common School Permanent Land Fund. And so when we head down that direction, we have to take this back to the voters of Wyoming and see if they agree with it.
Well, I like the idea of narrowing it down by picking two funds and starting from there, make the whole thing more comprehensible. So now we're back on Common School Public Land Fund, or we doing the PLF?
We're doing both.
We're doing both, doing those two.
I thought we were doing PMTF.
Ian
PMPF
and Brian
and-
and Polly, what this conversation
We're not
tells us
doing
is that
Common School.
what we need is kind of a write-up that in a step-by-step, non-professional language explains the purpose of going to to this type of a total fund return and the pros and cons of it, and why we'd be interested in doing it and following up, so everyone can understand that. And then we can re-articulate it to our other legislators and make sure that everyone understands what we're doing.
So, thank you, Mr. Chairman. So that was the other thing I had is we need a slide deck. We need a presentation to walk through these concepts, you know, and we can do that. And I think it'll help us and focus our thinking. And then if we move it forward, you know, we'll also be able to convey this message to other legislators and the public and voters more confidently if we can actually break this down to where we understand it.
And feel free to take all the help you need from Patrick and company.
So, Mr. Chairman, Drew, I'm with you on the total return thing. I think if we're going to create this reserve account that all income goes into it, all income needs to go into it. That's all I'm saying. I want to see some way that we're not doing diversions and intercepts. If we can do that, I'm on board all the way.
I think we all, I mean,
Okay.
that's what Alaska does.
I mean, we'll never be able to control future legislators. And we don't know what the needs are going to be, but we can give them direction. And if they see the benefit of what we do, then they're not going to screw it. So.
We'll have that discussion. We'll have that discussion.
Mr. Chairman, this discussion brings up something that we did talk about in management council. This is big ticket. Big changes, and so it gets back. I really do think we need to expand. more people involved. And, you know, I'd like to see us sponsor legislation, to at least add one member from both sides and go to a 7-7 committee.
Here, Mr. Chairman, I was going to say it was too big.
Well, that's a management council. Well, I guess we all can vote on it. 'Cause it's statutory.
Yeah, it's a statutory committee. You have to be in a bill. I'm trying to get enough people on here when
Understand.
3 or 4 or 5 of us are gone. Somebody knows what the institutional direction that we've been working on for. This will be going on to the 2.5 years on this topic when we first explored it. And so, anyway, just.
Okay, anything else? Any more instructions? I don't think there's anything else that we need to give you guys between now and.
Mr. Chairman, I don't think so. One issue I just had a question about was the issue of losses, and I don't mean to bring up that issue in its entirety. I think what we would assume is that the legislatures, in making this new structure, it doesn't really answer the question of how you want to net losses. I assume that I think for our purposes, we'll keep it the way it is. Is that your preference, or do you want?
Well, Mr. Chairman,
Go ahead.
I mean, I think part of 121 last year is we put into statute the loss. And I don't have any intention to change that in this. Is my feeling is that was kind of preliminary to head in this direction. And I don't think my opinion is we don't want to change that.
Yeah, well, at least right now,
Yeah.
as we develop these bills, we may want to change some definitions or tinker with them. I think that'll be a natural consequence when we evaluate. Okay, anything else?
Mr. Chairman, I do have one more thing, and that's just the issue of the November meeting. I think you and I had that quick discussion. The next meeting is currently scheduled for November 1. If there's any possibility that the House Bill 244 study is going to come at that point or later, it may be advantageous to reschedule this committee's meeting so that we'll have that information. I think that would probably be key for the meeting.
And at least have time to digest it. So.
Yeah. So LSO, I guess while we have everybody here, LSO will probably be talking to you to find out what other dates would work.
Yeah, so just see if we can find some, not too further after that, but, and we'll run our schedules, and if it fits everyone's schedule, we'll reset.
Oh, Thanksgiving at your house.
Yeah, I love to cook for Thanksgiving.
Mr. Chairman, it would be incredibly advantageous if the members of the committee would send us their availability in November. Being a little aggressive, because obviously we're not going to find a date that's convenient for everyone. So maybe that shouldn't be the standard, but if there's a date that you could make work, if you could let us know. I guess the easiest way is to let us know dates that absolutely can't work for you. It would be really, it would help us come to a date.
Why don't you on Monday send out an email request?
Yeah.
Great, will do.
Okay, anything else for the good of the state? Seeing none.